sort of investment that is? Yes. Good. Recording option is available. Ne? Who start the recording? Good. That's good anyway. Right. Okay, that's good. Sharif, ne? Sharif. The person who is recording that session, they can share the recording with the other students, those who have not participated here, because you are students, your batch is having approximately 100 students now. Okay, so how you can write the answer? Security X means that's a low risk as well as low return investment, whereas it's very suitable for the risk averse investors. Security X, which gives us a 16% investments with the standard deviation. When you're explaining the answer, don't take the word standard deviation, you take the risk. Risk of 12%, whereas it is a highly fit for the risk seekers. Why? High return and the high risk. So then, now you have to consider the investor's situation. Investor is a balanced investor. If you are a balanced investor, can you go with X or can you go with Y? No, you can't, right? So since Kavin is a balanced investor, a mix of the both X and Y would be beneficial because the nature is balanced. So therefore, so the Kavindi can allocate 50%, that means balance, right? 50% on the security X, meanwhile 50% on the security Y, and then she can balance high risk investments with the low risk investment. So therefore, she can diversify her investment into the two securities X and Y. Right? So because the reason is she is a balanced investor, right? But if you were given the question like that, if the risk nature has been change of the investor, risk averse investor, definitely you can select investment X, Y. She is a risk averse investor, right? But the other way around, if the nature of the investor is a risk seeker, you can select security Y. Why? Risk is high, meanwhile return also high. So therefore, likewise, you have to explain this scenario with the evidences, right? Part A, 10 marks question. So then when you are starting the theory question, don't directly start the question like security X and likewise. You have to just explain what you mean by risk and return to one sentence. Give the introduction to the question. Right? So when the investors are making the investment, they have to consider the risk and return. So in this set of scenario also, Ms. Kavindi need to consider the risk and return. Accordingly, security X. You describe the security X. So then you describe the security Y, nature of the security Y. So that means you have introduction part, beginning part for the question, and then the explanation regarding securities, and then your recommendation. Right, your recommendation. Sometime your question might be in the two section. First, identifying the risk and return trade-off, and then the recommendations likewise. So anyway, what you need, the first part A, consists in the theory part, which identify the theoretically how you can balance risk and return when a investor is taking investment decision with compared to the investor's behavior, investor's perception, right? Okay. Is that clear?
Yes, madam, very clear.
Right. So we'll move to the second part, right? Section B, normal calculation question, right? Can you all do the calculations? Sometimes there might be small case studies also. You will be given a small case and then you might be asked some questions. Like in the question number part A. Right. So here I have directly given you the based on the current economic scenario, you will be given a 3 states for a country for a 2 investments A and B. Right. What you need to consider is the expected return and then the expected risk and portfolio, risk and return and covariance and then the diversified impact. Right. Okay, we'll quickly do it. Hope you can see my screen. Word document. Is it visible to you all?
Yes, miss, we can see.
Yes, madam, can see.
Yes, madam.
Right. So then you can start off your workings. Part B. Right? Math ekkama karanna. Because you don't have a time. No? Right. 60%. It should be 60. 60%. Probability is 60%. And then the bad, that is 30% probability. And then the average, that is 10%. Right. So annual rate of return 10, 12, minus 11, 6, 15 and 9. Right. So then what is the first column? What should be the first column? What is the first step? You have to first calculate what? What you need to first calculate? Then පාඩම් කරලා නේද ඉන්නේ? Average return for A. නේද? How you can calculate the average return? That means R bar actually. R bar for A. How you can calculate? Yes? How we can calculate? Yes, yes.
Annual return rate divided by state.
I can't. Yes. So these are the future returns. If it is a future return, if it is a future return, zero 0.6, that means probability multiplied by
10.
10 plus then
0.3 multiplied by 12.
0.3 multiplied by
12.
12 plus 10
0.1
multiplied 0.1 multiplied by
minus
minus
11.
11.
11.
Right. So what is the answer? If you have, I'm not going to do it via the Excel sheet. So then see, sometime it might be not clear for you all. What is the answer? The answer 8.5. Then R bar for other stock. A stock P equals 0.6 multiplied by 6, 0.3 multiplied by 15, 0.1 multiplied by minus 9. What is the answer?
7.2.
7.2. What should be the next step once after the R bar calculations? R bar calculated. Then the difference between expected returns and then the R bar values, right? So how you can take the difference?
8.5 minus 10.
8.5 minus 10 or 10 minus?
10 minus
10
8.5.
minus
Very good. 10,
8.5.
very good. 10 minus 8.5. What's the difference? Then take the 12 minus 8.5. So this is very easy calculation, right? So where you all can have the 18 marks directly. 11 minus 8.5. This is for A. RA minus R by. Stock B, RB minus R bar B. Stock B, 6 minus 7.2. 15 minus 7.2. Minus 9 minus 7.2. So what are the answers? Answers 1.5 and then 3.5 is 19 point minus 19.5 minus 19.5. Minus 1.2, 7.8 and then last one 16.2. Okay, next one. What is the next step? Scared, right? You have to take the scared values and then apply in the probability levels. The difference between future return and then the R bar, you have to scared. The difference between R future return of B minus R bar B scared. 1.5 scared. 3.5 scared. And then 19.5 scared. Minus 1.2 scared. 7.8 scared values. And then the last one, it should be minus 16.2 scared. What's the answer? 1.5 scared.
2.25.
Good. 2.25. Here,
12.25.
12.25. Third one,
minus 380.25.
minus එනවද? minus නැති කරගන්න තමයි අපි scared value එක
Plus.
ගන්න.
Plus.
Plus. නේද? 19.5 minus 19.5 scared. What's the value? 300.
380.25.
380.25. 1.2 scared. 1.2 scared. What's the value?
1.44.
1.44. 7.8 scared.
60.84.
Minus 16.2 scared.
262.44.
And 60.44. Right. So next one, applying the probability level for these different
262, man.
62. Right. Okay. 262.44. Right. So the next one, applying the probability levels. So far we have applied 4 steps. Sorry, 3 steps, right? First step, if you are not clear again, R bar calculation. First step, R bar calculation. And then step number 2, the differences calculation. Third step, scared values, taking the scared value of these differences. And then the fourth one, applying the probability levels. Applying the probability levels. Right. Then you can take the probability levels, right? Probability level 0.6 multiplied by the difference is now 2.25, right? Again, for the B also, 0.6, that's the probability, multiplied by difference is now 1.45. 1.45. 44. Here 2.5. 0.3 multiplied by the difference is 12.25 scared value. Again 0.3 multiplied by 60.84. 0.1 multiplied by 380.25. Last one, 0.1 multiplied by difference is 262.44. You can take the answers. Tell me the answers.
1.35.
1.35.
3.675.
3.675. This one.
38.025.
0.6 multiplied by 1.44.
0.864.
864. Then
18.252.
26.24.
244.
Right. Now take the total. Yes, you can take the total.
$43.05.
Total for A. And then total for B.
45.36.
45.36. Okay. So what is this? I have taken it as a total. What is this? What the technical name for this one? What? Yes. What's the technical name? What is this? This is, yes, this is variance. This is variance. We are moving forward to calculate the standard deviation, whereas risk of this two investment, this is variance. Variance for A and the other one, variance for B. Variance A and variance B. Now we'll move to the question. Now all set, we have to answer for the question. What is the expected return and coefficient variation of A and B? What is expected return? Tell me the expected return. Expected return. Yes. Expected return A equals 8.5%. Right? Expected return for B, this is the answer for A. And then expected return of B equals 7.2%. Right, 7.2%. So then second, the same one, coefficients. Coefficient of variation. Coefficient variation. How you can calculate the coefficient of variation? Coefficient of variation. How you can calculate? Yes, risk divided by return. Am I correct? Now you can go to the risk and return lesson. If you have the tunes, you can go to that lesson. How you can calculate the coefficient of variation? Yes? Coefficient of variation equals risk divided by the return. Risk divided by return. Coefficient of variation equal risk divided by return. We call it as a CV. CVI in here, CV A and B. CV A and B. Right? Risk is how much? Risk is how much? Did we calculate the risk? No, we didn't. So therefore, you have to calculate the risk. How you can calculate the risk? Yes, risk of this investment. Risk is denoted by the standard deviation. Right? So therefore, SD of A, SD of investment A equals. How you can calculate the standard deviation? You have the variance. Square root of the variance is the standard deviation of the investment. Now you have to take the square root. Variance A for standard deviation of A, the other one calculation of standard deviation for B, standard deviation for B, that means variance of B. Variance of B. Variance A, how much is the variance for A? We have the answer, 33.05.
43.0.
Yes, 43.05. The other one,
45.36.
45.36. 36,
Yes, miss.
So then standard deviation equals. Standard deviation for E equals. How much is it?
6.56.
6.56. Standard deviation for B.
6.73.
6.73. 73. Right. Standard deviation means what? Expected risk. So therefore you have to write expected risk of A equals 6.56. Same time, expected risk of investment B, that is 6.73. 6.73. Right? You can do all the calculation in the question number A. Right. Now we have the task coefficient of variation. You can now directly calculate the coefficient of variation. It's very easy now. We have the risk, we have the return. Right? For the coefficient of variation for A. Risk is how much? Risk is 6.56. 5, 6. Divided by average return. Average return is 8.5. Then coefficient of variation for B. COB. Risk is 6.73 divided by return is 7.2. 7.2. Okay, tell me the coefficient of variation for these two stocks. For the stock A, what's the coefficient of variation?
0.77.
0.77. Coefficient of variation for B?
0.93.
0.93. Now we have already calculated coefficient of variation and then the risk and return for the investments. Right. Now we'll go to the question number B. Question B. What it asks? Question B asks, which stock do you buy and why? Now how you can rationalize your answer? As an investor, now we are going to buy which stock? A or B? A or B?
A can be.
A. Why?
The expected
What's the
return is 8.5.
Hmm.
And the risk also lower, 6.56.
Any other justifications? The investment buying decision, if it is an individual stock, you have to take the decision based on the coefficient of variation, not looking at just standard deviation and then the expected return. If you again ask a question, why you should buy this stock, you have to calculate the coefficient of variation. By taking the answer of coefficient of variation, you have to explain why you should buy this one, which is having the low coefficient of variation.
A.
A. Coefficient variation of B is 9.3. That means for a one return from stock B, investor has to bear 0.93 risk. Regarding the stock A, for a one return from the stock A, those who are investing in the A, just they have to bear the 0.77 risk. So therefore, as a rational investor, you have to select whichever the lowest one from this coefficient of variation. In this example, coefficient of variation for A is lower than coefficient of variation B. Therefore, investors, those who invest in the stock A, they just need to bear 0.77 risk for a one return, which again shows that consistency or volatility of this data set is low. Meanwhile, consistency of the having this return in future is very high of this stock A. So therefore, investors need to buy the stock A based on the coefficient of variation, based on the above calculation. So this need to be explained to have a 3 marks. So therefore, This should be your explanation, right? But you don't need to worry if your justification or if you're having some mistakes in the calculation, no need to worry. To identify some specific points, we are giving you the marks, right? If you are come up with the wrong answer for this entire question A and B, you are not going to lose entire marks, right? So therefore, no need to worry. Right. So we'll go to the question number B, that's done. Coefficient of variation, stock B. Based on law
Stock
coefficient of sorry, coefficient sorry A. Hello. Then section C, what it does. Now if you are going to form a portfolio, right? Now from where you can take that one? If you can't remember, just imagine by look, you can't remember the portfolio formula. You can go to the formula sheet. Portfolio return formula is given here. Right? What is this formula? Expected return of the portfolio. You can copy and paste it in your examination paper. Right? Okay. Expected return of the portfolio. How you can identify it? E R expected return of the portfolio equals. We have two individual stocks, right? 8.5 and 7.2. Right? If you are going to form a portfolio, can you entirely have the return from these two stocks? No, you can't have. So therefore, you are now receiving the return from this portfolio based on the weight that you have invested there. Right? So therefore, from the A, you are going to have 8.5 but proportionate. Right? Or else the investment that you made on this A and B is 40 and 60. Right? Question number C, if the portfolio is 40% in stock A and then B stock is 60%, what will be your expected return from the portfolio? Right. So therefore, investment in portfolio A, that is 40%, 0.4. Now we have invested in two stocks. So whereas we are receiving both return from the portfolios 7.2, but fortunately we have invested in that section B or the investment B 60%. So therefore you can take down the portfolio expected return 8.5 multiplied by 0.4 plus 7.2 multiplied by 0.6. How much is the portfolio expected return? 7.72. 7.72. This is the answer for C. So then expected, next question asks, expect covariance of the stock A and B. If you are going through the question, each and every question you have been asked, there is an order of answering. Right? We never ask the question, we never the given information in the examination paper without having an order. Therefore, if you are providing the answers for the question, you just go through the steps as you have been asked in the question wise. So therefore, question before moving to the portfolio risk calculation, what do we need? We need covariance. So therefore, it asks calculate the covariance between A and B. Right? A and B. Right. Okay. So then covariance. How you can calculate the covariance? Covariance equals. Tell me the way of calculating covariance. Can anyone remember? We need 3 columns. What is the first column? Covariance calculations. Yes, covariance calculations. First one, probability. Second one, what is the second one? Difference between, yes, difference between expected return and the R bar. So therefore, you have to take down that one. Probability levels 0.6, 0.3 and 0.1. So then differences. Differences. What are the differences? 1.5, 3.5 and 19.5. 1.5, 3.5 and then the other one 19.5. For B, minus 1.2, 7.8 and 16.2. Minus 1.2, 7.8 and then 16.2. What should be the last column? You have to now multiply probability and then the R bars. Right. That means 0.6 multiplied by 1.5 multiplied by minus 1.2 equals. Right. 0.3 multiplied by 3.5 multiplied by 7.8 equals. Next one, 0.1 multiplied by minus 19.5 multiplied by minus 16.2 equals. That means multiplying the probability P multiplied by the differences. Multiplied by the okay. Now you all can calculate these multiplications and take the total of it. It is the covariance. For the first one, how much is it?
Minus 1.08.
1.08. Next one,
8.19.
8.1.
19. 19.
19 and third one,
31.59.
5. Right. Now take the
This is
total.
a minus, right? 31.59 minus.
No, it's
Okay.
plus.
19.5, it's a minus figure. Oh.
We'll multiply it by
No, 16.2 also minus, no? Then
16.2 also
31
minus. Okay, okay, okay.
minus,
Okay, thanks.
31.59.
right. Now you all are very fluent then, meaning 19.5. I just have a manual calculator. Minus 16.2. Right. Its answer is 31.5.
Yeah, 59.
31.59.
59. Good. Now you can take the total of it. Total. Yes.
38.7.
38.7. Yes, it's the answer in the Excel sheet also. The answer is 38.7, right? Okay, that's a final answer. Now we'll look into the covariance calculated. That is plus 38.7. Now, covariance between Rn, you have been given 2 marks. Now, what is the risk of portfolio? Now, you all can't remember the portfolio risk calculation. Question number E. Go to the formula sheet, you have the formula sheet. So then expected return of the portfolio very clearly given to us, right? Expected risk of the portfolio, just copy down that formula to your answer scripts, right? So then you can calculate. Equals, right? Weight on portfolio. Weight on portfolio 1. What's the weight? Tell me the weight. What's the weight? 0.4. 0.4 square. And then you don't need to take the scared values. Just go to the variances and then take the variance directly. Or else if you want to wish to scare the expected risk, you can do that one, but no need. We have the direct values 43.5. 43.5. All these values we have already calculated values. And then scared of the weight on B, that is 60, 0.6. And then the variance is 45.36. 45.36. So then, since we have 2 stocks, that is fixed 2 and then weight 0.4. Weight on B, that is 0.6. Good. And then now standard deviation. Now we need the standard deviation. Standard deviation 6.56. And then the other one 6.73. Now you can include the covariance here. Covariance is 38.7. Now tell me the standard deviation of portfolio or else expected risk of the portfolio. How much is it? Yes. Calculate and tell me. Yes, you can give me the answer.
843.397.
Before the scared values.
Sir.
29.04.
20.
29.04.
29.04. Is that before the scared values?
After.
No, after. 843 before.
Right. Okay, because the scared values are a little bit behind, that's why. Right. So then expected value of the expected risk of the portfolio, that is 29.04. Right. The last one. F. What it asks? Diversified impact. Explain the diversification impact of forming a portfolio. What's your idea? What you need to actually calculate? Yes, what you need to calculate? Yes, what do you need to calculate first? Yes. What do you need to calculate?
Correlation of coefficient.
Correlation of coefficient, right? So there, we'll go to the tutor now. It's very clearly mentioned in your lecture notes as well, right? It's in part 2. Eh? How you can identify the diversification impact? Diversification impact generated, no diversification, modernized diversification. How you can identify it? Correlation coefficient, right? How you can calculate the correlation coefficient? Anyone remember calculating correlation coefficient? Yes, covariance divided by, this is the way of calculating it, ne? The covariance divided by which one? Covariance divided by individual stocks risk will give us the correlation coefficient, right? Correlation coefficient. So therefore, answer for G, F, right? Answer for F, calculating the correlation coefficient, right? Covariance is how much? Question covariance 38.7. Individual stocks return risk. Individual stocks risk. 6.53 multiplied by the other one. 6.73 multiplied by 6.56.
56.
Okay, what's your answer? Sometime you might get the different answer because I have just included these figures since it is a model paper. So, but in the question paper, it doesn't like that. Huh?
0.9.
0.90. Others also got the same answer.
0.876.
38.7 divided by 6.73 multiplied by 6.56.
0.876.
0.876.
76. Yes.
0.876 should be point. Okay, now looking at this answer, what's your? This is positive. This is positive. So therefore, what would be answer? Yes, what's your answer then? If it is positive and near to 1, do we have a diversification impact?
No.
Yes? No. So therefore, actually, by doing this diversification, do we have any impact? No. So therefore, you should conclude your answer since, right? Since the calculated correlation coefficient is positive and near to 1, it can be concluded that there is no diversification impact on forming a portfolio. Right. Hope it is clear to you the way how you can apply this calculation. So this is how you need to apply the calculations, right? Clear? Again, final one, since the calculated correlation coefficient is positive and near to 1, it can be concluded that there is no diversification impact on the forming a portfolio. Actually, no. Right? Positive means if the expected return is increasing, the expected risk of the other assets also increasing. Therefore, no need of forming a portfolio. Definitely, if it is negative, you have an impact on forming a portfolio. Right. Any question on the risk and return lesson? That means first part. Any questions? Hope no questions. So then we can move to the question section B. Section B, question number 2. Theory question. No any calculations, entirely theory for 18 marks. There are 2 questions, 10 and 8 questions. 10 and 8 marks. Right? Okay. You have been given just a small case. So what is it? Small case. Right? So they are trying to analyze the major financial figures during the year, and then looking ahead, this company is trying to go with a new investment by entering to the financial markets. That means 2 incidents, first lesson and second lesson combined now, right? So if you have been given a small case study, you have to read very carefully. So what has been they have applied in that case study, right? So then first one, define finance, and then what are the main financial decisions that the company need to have. If you are going to the first and second lesson, right, if we are going through the first and second lesson, what are the main points that you need to consider? We have main areas in finance, 7 areas. And then the other part in the first lesson, so the financial decisions and the role of the finance manager. So those are the very important 2 points. Other than that one, third one is the wealth maximization, right? So these are the 3 main areas in the first lesson, right? So main areas in finance, right? Main areas in finance, and then financial decisions, and then the other one, the other one you have to consider, is it wealth maximization, eh? Shareholders, wealth maximization, and profit maximization. So these are the 3 important points. Second lesson, so these are theory lessons, no? Main areas, how many main areas? 7 areas. Investment, corporate finance, and then the entrepreneurial finance, public finance, and then the other one, the investments, and then other 2, right? And then the financial decisions, if you are considering about the financial decisions, right? We have main 4 financial decisions. Actually, you don't need to remember those things. We are during the paper also, you have been given the question from those 4 areas, right? So working capital management, other one dividend decision, and then the capital structure decisions, and then the capital budgeting decisions. If you can't remember the financial decision, you go to the paper and look into the last question, the question number 7, 6, 5, and 7, 6, and 5. So then those are including on the answers for the question numbers in the first question, right? So if you can't remember, you can take down that on the questions and you can write down these things, right? So therefore, question number 2, it's asked about the main financial decisions. For out of that 3 main areas, here the question is given from the main financial areas. So then what are the main financial areas we have? Main financial decisions actually, sorry, main financial decisions. We have investment decision, and then we have the other one. Investment decision means capital budgeting decision. Right? Investment decision, that means capital budgeting decision. Right, I will answer. Capital budgeting decision. And the other one, you can same name, investment decision. What is the second one? Working capital management decision. Capital structure decision. And fourth one, dividend decision. Right. So these are the main 4 decisions you have to consider. So you can explain and write down. Right. So then second one, it asks about the how company use financial markets, right? How these company can use the financial markets. So how they, what are the, if you go to the financial market, how many financial markets? Directly we can identify the money market and capital market. What do you mean by money market? Money market. How we can start that question? Sri Lankan money market has 2 main areas. Sorry, Sri Lankan financial markets can be divided under several classification based on the security distance or a securities type. You can identify 2 main markets, money market and the capital market. Right? Money market means, so then you can come up with the second para. Money market refers to the money market refers what? Tell me. Money market means where the short term money market means what? Money market is what? Yes, where the short-term securities are traded. So what are the securities you can trade at money market? So then you can write down 3 or more examples from the money market, right? And then other one, capital market. What do you mean by capital market? Where the long-term financial securities are traded, right? Where the long-term financial securities are traded, shares, bonds, debentures, and all the things. So then you can write down the capital market, right? So then you can identify based on the type, right? So based on the type, you can identify again another two markets, primary market and the secondary market, right? Primary market means where the securities are traded at first time, and then you can give some example for the primary markets, and then you can go to the secondary market, explain the secondary market. What do you mean by the secondary market? Where the securities are traded at second time from the primary dealers, right? So then you can just write down the form of the secondary market. Colombo Stock Exchange also coming under the secondary market as an example and likewise, right? So therefore, you can just look into the financial market. Sometime it might be from the specific area from the financial market, not the entire financial market. So therefore, you can go through the financial markets specifically, right? Okay, question number 3. Question number 3, it's from the time value of money and then the bond valuation. Time value of money and then the bond valuation. First question, again a small theory part question, as well as there are some calculations also, right? So this company, they have the two options, right? So the first option is regarding from the another lump sum amount and the other one annuity, right? From the section 3 again, you can refer the formula sheet. We'll go to just read the question. So they have two options. The first option is the supplier will, or the respective companies has secured a large order. They received an order from the European distributor, right? First one, distributor propose a pay for a 5 million after 6 years from now for the entire shipment. Right? That means 6 years from now. That means those are future value. These 5 million is a future value. Right? And then other one, they have the other option. That means supplier, the local trader, they agreed to give the 900 per year for a 5 years period. First one, after 6 years, that's the first option, and the second option, annuity. Right. So then management of this company is currently evaluating whether to accept the deferred lump sum payment or then the annual installment payment for the local buyer or the European buyer. Right. So taking into the account of time value of money. Now you can refer, this question is from the time value of money. Right. Okay. What is a favorable order for the company? how you can consider the favorable option for this company. What you need to consider? If you are considering about the favorable order, at which time point you are going to evaluate this one, evaluate these decisions at present, right? So how you can identify the favorable option? You have to evaluate the decision right now. Right now means present. These are future values. So therefore, what you need to consider is you have to calculate present value of these two payments which are receiving in the future, right? That means future value of the, present value of the future cash flows, even it's a lump sum. And the first one, other one, that's a annuity, right? For the question number 3 also, you can have the help of the formula sheet, because why? In the first formula from to the 1, 2, 3, 4, 5 to the fifth formula, you have been given the answers or the answers for these questions, right? First formula, what is it? Future value of the single cash flow. Second one, future value of annuity. Present value of a single cash flow, present value of annuity cash flow, and then the present value of the perpetuity. Why I have given here the present values? By using the present values, you can go to the future value formulas, because there are some adjustments to be made when you are obtaining the future value formula. Right. So then out of these formulas, which one is helpful for us to calculate the present values? Yes. First, second, third, fourth, fifth. Perpetuity, no. And then present value of annuity cash flow. So therefore, 1, 2, 3, 4. Fourth one is can be used to identify the annuity. And then the other one, what is it? Third one also can be taken for the identifying the present value of the lump sum payment after 5 years. Quickly calculate and tell me. Question number 3, right? So we are receiving 5 million. 5 million multiplied by 1 divided by 1 plus R. What's the required rate of return? Required rate of return is that given to us. I missed that one, no? Just take it as a required rate of return. R equals 10%. R equals 10%. So therefore 1 plus 0.1 to the power how many years? We are receiving the lump sum amount after 6 years. So therefore to the power 6. What's the value then? Yes. 1 divided by 1 plus R, that means 0.1 to the power 6 multiplied by 5 million. What's the answer? 2 million. Am I disconnected? No. Are you there?
Yes, ma'am. 822
822
369
369 and then
0.65.
0.65. And the other one, what is it? That is a annuity, the present value of the future. Present value of these annuities. Right. So what is the formula you have to take now? This one. The PV equals annuity multiplied by 1 minus 1 divided by 1 plus R to the power n divided by R. I have given the formulas to you, so then you have to understand the way of taking the help of them, right? එහෙම නැත්නම් ෆෝමියුලා ෂීට් එක තියෙනවනේ කියලා එන්න එපා. එතකොට තේරෙන්නේ නැහැ ඉස්සෙල්ලා එකේ ගණන් හදලා ඒක ඇප්ලිකේෂන් එක අරගෙන එන්න. එතකොට තමයි තේරෙන්නේ ආ මේ ගාන තේරෙනකොට මෙන්න ෆෝමියුලා එක තියෙනවා. එතකොට මමතක වුණත් ගන්න පුළුවන්. එහෙම නැතු ෆෝමියුලා ෂීට් එක තියෙනවනේ කියලා ෆෝමියුලාස් පාඩම් කරන්න නැතුව වෙන්න එපා. එහෙම වුණොත් හදාගන්න තේරෙන්නේ නැහැ. හදා ගන්න පුළුවන් තේරෙන්නේ නැති මේ. මොන ෆෝමියුලා එක මොකටද ගන්න ඕනේ කියන එක. Right. Annuity is how much? 900,000. Multiplied by 1 minus 1 divided by 0.1. For how many years? Now it is different. Here 5 years. 5 years. Divided by 0.1. What's the value of this present value of the annuity? Yes, 3 million 400
411 708
700 092 ne?
yes ma'am.
Right. Okay. Now what is your decision? Present values calculated. Annuity is annuity 3.4 and then the lump sum amount 2.8. Which one need to be selected? You have been given the 6 marks, so that means you need to have an explanation as well. Since the present value of neither. Since the present value of annuity as rupees 900 option number 2 is higher than the present value of lump sum amount. That means option number 1. That means option number 1. Present value of the annuity. Present value of annuity 900,000. Option is higher than the present value of lump sum amount. Company can select the option 2. Right. Option number 2. Right. Hope it is clear the way of calculating the present value and future values. You can just go through that note, then refresh your knowledge and come. Anyway, this time it is calculating from the present values, not the future values, right? Second one. Question number 3, it's regarding from the covering 3 sections. The first one is the time value of money exactly for 6 questions, no any additional marks. That's fixed 6 marks. This set of the Small case study question. And then the other one, 9%, 9 marks for the bond valuation, and the remaining 3 marks for the irredeemable preference shares, not a theory part, just a small calculation. So therefore, you can look into the irredeemable preference share valuation, right? Okay. Regarding the bond valuation, this is the last time question, but this time it is something different, but the time, this time this is something different. Format is different, but the content is same. Therefore, you can practice the way of calculating the value of a coupon bond. It might be semi-annual, annual. Anyway, the core is same. Same. The presentation is something different, but I have given here to practice the value of the calculating the value of the bond. I have extracted the question from the last year paper. You can practice this one and come. You can earn the 9 marks directly, right? No any changes. Straightforward question. So we'll go to the identifying these things. If you have not given this time, if you have not given this format, the table format, do just look into that, the small case study, and then identify the 3 different bonds. Right? Those are highlight, those are in the bold color. So then you can conclude this information. Right? Time maturity, that means N. Face value, all the face value are 1000. That's fixed. And then the coupon rate, are there 3 different coupon rate? And then the coupon rate frequency, semi-annual or annual. Once you finalize these answers, summarize these 4 content, so then you can directly calculate the value of the bond. Right? How you can calculate the value of bond? If you can't remember the valuation of the bond, what you can do? You can go to the formula sheet. Where the formula sheet include the bond calculation here. But it's not directly, right? So bond calculation formula is not directly given to here because we can't given that one since we have a lot of the bond types. So therefore, base for the valuation, that is intrinsic value. Intrinsic value means calculating the present value of future cash flows. Future cash flows means regarding a bond, we have 2 cash flows. Redemption price, that means face value, and the other one coupon. You have to take present value of all coupons and then the present value of the face value. Right, so we'll write it down. Bond value equals present value of all coupon payments plus present value of redemption price, that means face value. Redeem at face value. Okay. Right. Normally we are calling it as a bond value means V equals. Right? V equals. What's the formula? Coupon payment CP multiplied by, now you can take the help of the annuity factor, annuity formula that we have already applied in the first section, multiplied by coupon payment multiplied by annuity factor. This is what? This is the present value of all coupon payments, this formula, and then plus. The other one, you can take the help of the first formula, right? So what is that? Future values. Converting the future values into the present context, that means future value means here face value. Face value divided by 1 plus I to the power n. So that means this is the present value of redemption price, second one. Right. Okay. You can calculate the values. Just quickly calculate the values and tell me. Coupon payment for the first one. How much is it? This is semi-annual coupon payment. Coupon rate is 30. Right? How you can calculate the coupon? Then මතක නැත්නම් කොහොමද calculate කරන coupon payment එක? Face value 1000 multiplied by coupon rate, that is 0.13. Divided by, this should be divided by 2. Why? That is, this is a semi-annual. This is semi-annual. Plus face value divided by, multiplied by, this should be multiplied by the annuity factor. If you have the short formulas, you can use, no issues. One that is fixed. So then 1 minus 1 divided by R. What is the R here? You have given here. R means require rate of return for the investor. This is here. Right? Require rate of the investor. How much is it? 11%. 11%. Right? 0.11. 11% means 0.11. To the power n. For how many years? Maturity period 40 years. Maturity period 40 years. 40 years. Now this is a semi-annual. So therefore always you have to divide the I by 2. N multiplied by 2. Right? 40. 40 here to the power 40 multiplied by 2. Multiplied by 2. And then 0.11 divided by 2. This is how you can calculate the annuity factor. Annuity factor. So then plus. Plus. Face value 1000. Face value 1000. 1000 divided by 1 plus I means 0.11 divided by 2. Why? This is semi-annual. Multiplied by 40 into 2. Right. What's the value of the bond? Anyone who have calculated the value of the bond equals?
Madam, 1179.29. Could you please
1179. 179.29.
179.29.
Okay. So you can check whether your answer is correct or wrong by looking at two figures. What those two figures are? Yes, what those two figures are? මම ඔයාලට මේ hint එකක් කියන්නේ. ආන්සර් එක දිහා හරිද වැරදිද කියලා බලන්න පුළුවන් කාගේ දිහා බලලාද? coupon rate එකයි required rate of return එකයි දිහා බලලා. කොහොමද එහෙම බලන්නේ? required rate of return කියන්නේ මොකද්ද? ඉන්වෙස්ටර් බලාපොරොත්තු වෙන ගාණ. ඉන්වෙස්ටර් අඩුම තරම 111ක් ඕන. හැබැයි කූපන් එක දෙනවා කියද්දි ඉන්ට්‍රස්ට් එක කියලා හිතන්නේ ඉන්ට්‍රස්ට් එක 113ක් දෙනවා. ඒ වගේ අවස්ථාවලද මොකද වෙන්නේ අනිවාර්යෙන්ම? මොකද වෙන්නේ? අනිවාර්යෙන්ම වැලියු එක 18 වැඩිද අඩුයිද? වැඩිද අඩුයිද? 18 වැඩි. ඇයි ඒ හේතුව? බලාපොරොත්තු වෙන ගාණ 11යි හම්බෙන ගාණ 13. එන අනිවාර්යෙන්ම 18 වැඩි වෙන්න ඕන. Second one. This is the first one. No? Value of SAM. SAM means Sampath Bank. Right. You all can do the second one and third one. No? So then the other one, commercial bank, COM. Commercial bank value equals again same formula. It's an semi-annual. Semi-annual, but the value is 1000 multiplied by, now the coupon rate is 11%. Now definitely this bond should have a value of 1000 because why? Coupon rate is similar to the required rate of return, whereas exactly face value equal to the bond value, right? So anyway, we'll calculate multiplied by 11 divided by 2 and then again 11 divided by 2, number of years, that is again 10 years. 10 multiplied by 2 and then 11 divided by 2. Face value is 1000. 11 divided by 2 and here it need to be changed. It need to be 10 multiplied by 2. Value b is equal to the 1000. Right. Third one, that is HNB. HNB. Right? HNB value. HNB value. Again, same formula. You need to consider the present value of all coupon payments and then the present value of the face value. Right. Coupon is 1000 divided by 1000 multiplied coupon. How you can calculate the coupon? 1000 multiplied by the coupon rate now 7. Even we are expecting 11%, we receive 7%. So therefore 7, 0.07 divided by 2. No, this is annual. So therefore no need of dividing it by 2. So then 0.11 divided by not 2. It's same as 0.11. Again, no need to multiply the number of years into 2. Here the number of years are 4 years. So then divided by 0.11. 0.1. No need of multiplying it by 4. That is just 4. Right. So what's the value of this bond? HNB Bank equals, now it should be below than 1000. How much is it? 800. What is the value? Yes, what is the value of this bond? Yes,
Means, is it 875.89?
870.
75.89.
75.89.
89.
Others, have you got the same answer? No answers. It should be below than 1000. The power of 4. 1 divided. Two hundred 17.15. $658. Yes, it is 875 point. I received the answer 90. Anyway, your answer is correct. 8.9. The present value of the all coupon, that is 217.17 plus the other one 658.73. Right. So then it asks not to calculate. What you have to do is you have to evaluate the buying decision. Right? Okay. So the investor wished to buy this investment for the sum 1100 and then com, that is 1000, and then HNB at 800. Right. So 800, here it is 1100 and here it is 1000. Commercial bank, that is okay. Why? The value also equal to the purchasing price. So therefore no issues. The investor can buy that asset. No issues. And then regarding the SAM, he is going to buy the asset 1100, but the real value is 1179. Buy or not to buy? We have to buy. Right? For the next one, HNB. So the value is 875, that 875, whereas it is trading at discount below than the face value, then he's trying to purchase it for 800. Again, that's a good decision. Why? So he's intended to buy the value at 800, purchase the bond at 800, but whereas the real value is the 875, even it is a trading at discount. Right. Okay. Hope it is clear the way of calculating the bond prices, bond values. Question number 3 done. Any question from the question number 3? Any question from the question number 3?
Miss, can you please explain what about Sampath Bank decision? Is it better to go for Sampath Bank or?
Yes. All 3 we can buy. Because why? So he is going to try to buy the asset for 1,100. No. In this set of an incident, the Sampath Bank share is trading at premium. No. Right? 1,179 because of the current market scenario. Right? Real value is 1,179. That means trading at premium. ගාන්ට වඩා වැඩිපුර විකිනෙන්නේ. හරිද? එතකොට මෙයා ගන්න හදන්නේ කීයද? 1,100. So therefore we can buy. Second one, 1,000 we can buy. Third one also, the investor is trying to buy at 800, whereas the real value is 875. Clear?
Okay, Miss, thank you.
Right. Okay, we'll go to the next one. Next question. Question number 4. Question number 4, entirely from the cost of capital calculation. That means there is a small question from the theory part. Right? So what is the importance of what is the importance of calculating the cost of capital? And it might be the value and the nature of the cost of capital decisions, and how the cost of capital decision link with the other lessons and etc. Anyway, you just need to identify what is the basic understanding or basic purpose of the calculating cost of capital for an organization, for a company. Why do they need to calculate the cost of capital? Because the company is funding from several sources, right? But while they are while they are collecting the funds from the different sources, they have to invest in different investments. So therefore, if a company going with the investment decisions, so they have to expense a vast amount of money of the company on this investment. So therefore, before moving to the investment, the company need to determine whether they are going with the profitable project or not. How they can identify whether it is a profitable project or not. They have to compare their cost of capital, the amount that they have already utilized in the company, how much of cost of capital they are paying for this, their shareholders or fund providers, versus the amount that the company is trying to have an earn as from their investment. They have to compare these two, and they have to take whether the investment is whether this investment is worthwhile or else not. To identify this profit from the new project, definitely company need to calculate the cost of capital. Right? Company need to identify what is the overall rate of return that they are paying for the outsiders. Therefore, it is really, really important of the calculating the cost of capital. Meanwhile, what is the nature of the cost of capital, decision? So those things you have to find out. The theory part, just look into the lecture notes and etc. in past paper questions, then you can identify what is the importance. Right. So then, again, what we are asking: cost of ordinary shares, cost of preference shares, and then the cost of debt, and then weighted average cost of capital. Again, for these questions A to D, you can take the help of the formula sheet. The weighted average cost of capital formula is given to here. You can copy down that one and you can calculate the cost of capital. Preference share valuation also you can do it. If it is a redeemable preference share, you can consider this formula as well to calculate the cost of capital. Right. Okay, we'll just look into that question. Right. When you're calculating the cost of capital of these each sources, first task is you have to understand what type of instrument this is. Whether it is debt, whether it is equity. Right? If it is debt, you have to identify, is that traded at par, issued at par, or else issued at discount value. And then the other one, if it is a irredeemable preference share, you have to identify whether it is a what sort of a share, what sort of a irredeemable or what sort of a preference share, whether it is irredeemable or the redeemable preference share. Regarding the equity shares, you have to identify whether it is internal generated or external generated. If it is external generated, you have to consider is that having a growth rate, is that having a flotation cost and etc. Right. So ordinary share, preference share, and the bonds valuation. That means it's clear. Bond, this is a type of bond, and this is the ordinary share, and this is the preference share. Right? Quantity were given to you. Why do we have given the quantity? Because you have to identify the capital structure of the firm. Right? So capital structure of the firm can be identified by multiplying the quantity with the issue with the market price. If they have been asked calculate the weighted average cost of capital on the market values, fine. It's very clear. You have to calculate the weighted average cost of capital based on the market value, whereas you can take the help of quantity and then the market price in identifying the entire value of the firm. Right? Entire value of the firm equal debt equity plus the preference share market values. Right. So then the next column, dividend coupon payment, and then any special note for the each and every capital type. Right. First one, dividend expected to grow at 8% per annum. That means this is constant dividend growth model. And then preference share, it is irredeemable. And then bond, it is a 6-year maturity, redeem at par. Right, redeem at par. So therefore, you can take the help of the KD, cost of preference share. What is cost of preference shares? KP, and then KP, and then the ordinary share, that is KE, and then cost of debt, that means KD 1 minus tax, cost of debt after tax. Once after you calculated these three, and then you can calculate the weighted average cost of capital. Right. So you can, yes, do that one. Okay, we'll do it quickly. Question 4. First one, KE. Okay. You can attempt. Give me 5 minutes, right? You can do it. Okay. So have you calculated the KE? Anyone who calculated the KE? What's the formula that you can use to calculate the KE? Yes. Are you all sleeping?
No, madam.
So then what is the formula? මොකද ගත්ත formula එක? KE D1 divided by P0 plus growth rate නේද? So then what is the KE? D1 8.64 divided by P0. P0 you can take it as a 180 plus growth rate 0.08 equals. Then you can calculate the KP and KD. Right? And then you can identify the weighted average cost of capital equals. I'm not going to calculate it. First, calculate one by one and then calculate the weighted average cost of capital. To calculate the weighted average cost of capital, you have very clearly given the values of these. The B, that means market value of debt plus MV, that means market value of preference shares PS, and then plus market value of OS, means ordinary shares, right? Right. Okay, value equals. No. Right. So then question number 5, again question number 5, you can do weighted average cost of capital, the part, calculating KD, KP and KE, and taking the all consideration of KD, KP and KD, you can go with the weighted average cost of capital. Right. We have 3 more questions. Anyway. Right. So question number 5, I hope you all can attempt the question number 5 because that is the investment decision. capital budgeting techniques are there. You have identified the capital budgeting techniques in the last semester also under the cost and management accounting subject. That means in calculating NPV, calculating IRR, calculating profitability index, and then those are the some ARR calculations and the payback period and discount payback period, right? So this time, so in this question, I have given the NPV, IRR and profitability index calculation. First, you need to calculate and then you have to recommend whether to accept a project or else reject a project, right? So how you can calculate the NPV? Read in this time also you have this set of a description scenario, and then you have to go with the calculation and make the recommendation for the 18 marks. So I hope you all can attempt the question, this question. This is really easy, question number 5, right? So the initial investment for this investment, that is 1.8 million. That means that is initial cash outflow. So therefore, the product is expected to sell for 25 until the from unit initial. That means in this year 1, that is 25. With the anticipated annual selling price increase by 4% because of the inflation. That means year to year, what happened? The selling price is going to be increase, right? Sales price going to be increase. So then variable operating cost of the project, that is 10%. And then fixed cost is 160. Both are expected to be increased by 3% annually. Right? Forecasted demand for this project, that is over for a 4 years period. That means 55, 65, 110 and third year 50. Sorry, fourth year 50 and then 50, right? All the unit produced are assumed to be sold. No any opening inventories and then no any closing inventories. Right? No any scrap values also. For the purpose of investment appraisal, the company applies a normal discount rate of 10% per year, while the taxation is ignored in the evaluation. No need to consider the taxation. Right. What you need to calculate, you have to calculate the NPV and then you have to calculate the IRR and you have to calculate the profitability index. PI means profitability index, right? So this time I'm going to test NPV and the profitability index. Even here I have included as the IRR calculation too, but you don't need to worry about the IRR. Just practice the NPV directly and the PI, profitability index, right? So how you can calculate the NPV calculation? You all know these things. Right? I will just go to the Excel sheet, the way of calculating the NPV, right? This sign, so the description, 0, year 0, first year, second year, third year, fourth year, right? So NPV calculation, right? First one, you have to identify the cash inflows and outflows, right? Cash inflows. We'll make the initial investment first, right? Initial investment in year 0, that is minus 1.8 million. $1.8 million. So then you have to consider the cash inflows and then cash outflows. Cash inflows and outflows. Right. Meanwhile, when you are doing the calculations, take out the workings. Otherwise, you are going to mix these things, right? Workings. Workings. Again, year 0. To 4 years. Now, when you are doing the calculation NPV or IRR or profitability index calculation, first draw this format. Once don't read, you just read the question, right? You just read the question and then make this format first, right? And then you read the question very carefully in the second time, right? Because you all can attempt this question and you all can attempt the question and you can have the marks. Entirely 18 marks you can gain, huh? Right. Okay. Product is expected to sell for 25 per year. That means initially with the anticipated annual selling price 4% inflation. Sales income. Sales income, how you can identify the sales income? You have been given the prices, right? Starting from 25 and then inflation. So that means how you can take the value. 25 now increasing multiplied by 1 plus 0.04 to the power 1. Why we are taking to the power 1? අවුරුද්දට 104 ගාන වැඩි වෙනවා. එහෙනම් 104 ගාන වැඩි වෙනවා. 0.04 26. Right. Third year and fourth year. To the power 2. To the power 3. Right. Number of units. අපිට number of units උත් ඕනනේ. Number of units. අපි දන්නේ තාම එනකොට අපිට sales income එක දාගන්න ඕනේ. Right. Units. Right. Variable operating cost 10% per unit and then fixed cost is 160 per year. Fixed cost is 160. Both are expected to raise on the 3% annually. I mean, then එයත් වැඩි වෙනවා. Then variable cost. Variable cost. 10. And then fixed cost. Again 160. මේ දෙන්නත් මොකද වෙන්නේ? වැඩි වේගන යනවා. Same can be identified. 10 multiplied by 1 plus 0.03 to the power 1. To the power 2. Sorry. To the power 2 and then to the power 3. Meanwhile, fixed cost also same. 160 multiplied by 1 plus 0.03 to the power 1. 2, 3. Right. Now okay. No opening and closing inventory no. එන ඉප ඔයන මේ හදන හැම එකක්ම විකුණන්න ඕනේ. Production units 55, 65, 110 and 50. Number of units 55, 65, 110 and then again 50. Now you can take the sales income. Sales income, number of units multiplied by per unit. And then variable cost also, you have to identify the variable cost based on the number of units you produced. So therefore, this is working number 1, this is working number 2, and this is working number 3 for sales, variable cost, and fixed cost. Now again, you can identify the total variable cost multiplying the units by the variable cost. So then you can make here the variable cost, number of units, and then per unit cost, and total. Selling price. Now you can take these 3 expenses and income, 2 expenses and income to the cash flow calculation, right? We have sales income, that means inflows, and we have outflows, which are variable cost. Variable cost. These are sales income. Sales income, these are fixed cost. Right? You can take the fixed cost here. Right. Then what should be the next step? Net cash flow. Net cash flow. Sales income, or else the cash inflows minus cash outflows. Initially you have minus cash flow. Right? First part done. Right? First part done. Step number 1, identifying individual cash flow. Step number 2, identifying net cash flow. Right? Step number 3, what is the step number 3? Converting the present values. Discount rate. Discount rate here is 10%. 10%. So that means you have to calculate the discount factors. You will be given the discount, the table, so then you can take that directly that figure. But for here, I will just calculate 1 divided by 1 plus 0.1 to the power 1. 0.91, 0.83, and then 0. This should be 4. This should be 3. Right. And then take in the discount factors, multiply the net cash flows with the discount factors. So then you can take the discounted cash flow. These are what? These are discounted cash flow. Right? After the discounted cash flow, step number 4. That is it, NPV. How you can calculate the NPV, net present value? Take the sum of all cash inflows during the project and then minus initial cash outflow. So therefore, in this project, NPV is 1,134,115.06. Right? 100.6. 15.06. So therefore, based on this decision, right? So tell me whether do we need to accept or reject the project? NPV is positive, right? Since the NPV is positive, company should invest in this project. How you can calculate the IRR? You need to take another discount factor and take 2 discount factors and then calculate the IRR. Right. How you can calculate the profitability index, PI? Profitability index? Present value of all future cash flows divided by initial cash outlay. Initial cash outlay 1.8 million. If you divide the future cash flow by initial cash outlay, you will given 1.36. So therefore, it is higher than 1, whereas you can technically confirm, you means company can buy the investment. How you can conclude here, since the profitability index, PI, is higher than 1, company can invest in the project. Right. Okay. So this should be a conclusion. Right. The NPV calculations are very clear. If you are not clear on the NPV calculation, again do it because it might be very familiar to you all, whereas you can earn the high marks from that question. Always try to attempt the question, whereas you all are always friendly, and sometimes you might identify those things in the first year also. Maths calculations, right? The statistics or the mathematics calculation you identified, and then the cost and management you identify. So then in this subject also, if you can go with that calculation part, whereas you always previously touched those things, it's very familiar to go with this. It's very easy to catch those areas because you already attempt those things. Right. මේ වගේ වෙලාවක මුළු සිලබස් එකම බලන්න නැත්නම් ඒ වගේ දේවල් තමයි අපි ටච් කරන්න ඕනේ. නැත්නම් ඔක්කොම සිලබස් එක වань ගියම තේරෙන අපි කලින් ඉගෙනගෙන තියෙන නැත්නම් එතකොට ඔයාලට තවත් ලේසි මේ සබ්ජෙක්ට් එකේ තියෙනවා. එතකොට ඔයාලට කලින් පොඩි හැරම දැනුමක් තියෙනවනේ ඉගෙනගෙන තියෙන නිසා. Right. Question number 6. again from the working capital, and question number 7, it's from the entirely the capital structure decision. I always, when I was doing the lectures also, I told you. So I'm giving this optimum capital structure firm, optimum capital structure question from the same area. So therefore you can practice that one. Yes, that's it. Yes, and then the leverage, financial operating leverage and the financial leverage calculation. And then if you change the EBIT and other things, how it might be impacting for the EPS and ROE calculations will be tested there. So those are the main areas in the capital budgeting decision, capital structure decisions actually. And then if we move to the working capital question, this is the working capital question, whereas I ask you to do the calculation. So therefore, sometime it might you can practice the question and come. Sometime you will be given the calculated answers. And it might be highlighted the comment on the efficiency of the working capital management practices. If you have given the calculated figures and then the sales, the credit values and etc. So therefore you all need in working capital management, in the sense we have the 3 dimensions in the working capital management, mainly inventory and the receivables and the creditor management period. Right? We can calculate the net operating cycle. You can calculate the gross operating cycle. That means cash conversion cycle, whereas net operating cycle, and then the other one gross operating cycle. So therefore, you need to identify that as a business as analytics student. So you always need to analyze this financial information. So therefore, you can practice the way of calculating it. Meanwhile, you can go through the interpretation of this working capital management, the calculations as well. So therefore, you practice both, right, regarding the working capital management, right? Most probably, a lot of theory parts are there in the working capital management rather than doing the calculations. Right. Hope it is clear to you. Right? It's very easy paper it compared to the other papers this time onwards. So therefore, any question from this paper? You need to anything to clarify, or else you need to anything to ask? Yes. මොනවාරි අහන්න තියෙනවද ඔයාලට?
Madam, shall I send you answer?
Which answer? You mean I need to upload these answers?
Yeah.
Okay, the things that I have concluded so far, I will upload that one to the LMS. Okay? You can refer it.
Okay.
Any questions?
Hello, madam.
Yes.
Madam, can you go to the working capital question? I think it's
Yes.
number 6. Also, madam, this is not the paper that you uploaded during the class time, I think,
No,
right?
this is
It's new
separate.
one.
Yeah.
Okay. Okay, madam. 6, I think 6. Yes. Yeah, in the
Yes.
6. Yeah, madam. No, this is not the one. I'm asking for this raw material holding period and
Sixth
so
one, eh?
yes.
Sorry. Yes.
Madam, can you go please to the questions area?
6 නේද පුතා?
Yes, madam.
Yes. what
ඒ
පේනවද?
ඔව් මට
Page
පේනවා
number
madam.
5, maybe, madam.
Yes.
Yes,
Uh,
this one. Madam.
Is this one,
There
madam?
is a something, ne? Yes. Credit sales the.
ඒකේ මේ මැඩම් දැන් raw material holding period එක එතකොට මේ holding periods ටික අහලා තියෙනවානේ. එතකොට අර අපේ theory part එකෙත් කරානේ මේ theory part එකේ කරානේ මේ periods ගැන මේ ඔය මේ raw material period එක එහෙම. එතකොට ඒකයි මේ අහන question එකයි දෙකම similar නේද මැඩම්? මට පොඩි question එකක් තියෙනවා. මොකද මම ඒක කරද්දි මට ඔය issue එක ආවා.
තියරි එකේ කියලා කියන්නේ මම ඔයාලට questions දෙකක් කරාද එක question එකයිද කරේ working capital මම ඔයාලට questions කීයක් කරාද එකයි නේද කරේ
ඒකේ කරේ මැඩම් question එකක් නෑ
ඔව් මම question ඒක කරේ මං හිතන්නේ holding period එක දීලා ඔයාලගෙන් තියෙන inventory එක ඇහුවනේ
ඔව් එතකොට මැඩම් අපි ඒ ෆෝමියුලා එකටමද මේ ටික කියන්නේ ප්ලග් කරන්න ඕනේ හරි එකම දේ අහලා තියෙන නේද මැඩම් ඒක
ඔව් දැන් මෙතනදී මේක ඔයාලට ක්ලාස්රූම් එකේ කරපු question එක නෙමෙයි තියෙන්නේ මෙතන. මෙතනදී ඉන්වෙන්ටරි ලෙවල් එක දීලා ඔයාලගෙන් හෝල්ඩින් පීරියඩ් එක අහලා. මම ක්ලාස් එකේ කරේ හෝල්ඩින් පීරියඩ් එක දීලා ඉන්වෙන්ටරි ස්වයිප් එක තමයි කරේ. ඒතර මේ සැරේ ඔයාලා ගණන් දෙකම බලාගෙන ඉන්න. එතකොට ඕවරෝල් අයිඩියා එකක් තියෙන්න ඕනේ. එතකොට ක්වෙස්චන් එක ලියන්න තියරි ක්වෙස්චන් එක ලියනකොට එතකොට මේ පාර ඇත්තටම මේ පාර මම ටෙස්ට් කරලා තියෙන්නේ දෙකම එකට කම්බයින් කරලා කොහොමද ළමයා ඉන්ටර්ප්‍රිට් කරන්න කියන එක. ඒතකොට ඒක බලන්න ඒක ඉන්ටර්ප්‍රිට් කරන ඔයාලට කැල්කියුලේෂන් වලට අවබෝධයක් තියෙන්න ඕනේ යම්කිසි තාක් දුරකට.
මැඩම් දැන් ඒක මම මේ මොඩල් පේපර් එක කරද්දි අර මේක මැඩම් කලින් අප්ලෝඩ් කරලා අපිට ක්ලාස් දීපු මොඩල් පේපර් එක කරද්දි try කළා මම කරන්නේ ඒක. එතකොට මට එතනදී question එකක් ආවේ මට මේකයි දැනගන්න ඕනේ. දැන් ඒකේ අහලා තිබ්බ මැඩම් raw material holding period එක. එතකොට raw material holding period එක අපි හොයන්නේ average raw material මේ ඉන්වෙන්ටරි එක අරගෙන ඒක මැටීරියල් යූසේජ් එකකින් බෙදලා 365 වැඩි කරලා ඒක හරි ක්‍රමයක්.
හරි
මට දැනගන්න
මෙතන පොඩි ඉෂුව එකක් ආව මට මේ ක්‍රෙඩිට් පොලිසි එක. මෙතන all the sales and credit basis කියලා ඊට පස්සේ මම මෙතන ආපහු 60 80 කියලා දාලා දෙනවා credit basis එක. එතන මේක 80 අයින් වෙන්න ඕන. ඒක ඔයාලා assumption එකක් දාලා ලිව්වට ගැටලුවක් නැහැ. ඔයාලට මොන හරි issues තියෙනවා නම් කෙලින්ම assumptions කියලා දාන්න කගින්වත් දාන්න නෑ assumptions කියලා දාන්න star mark එකක් දාන්න circle හරි star mark එකක් හරි දාලා ලියන්න කිසිම ගැටලුවක් නෑ
ඕකේ මැඩම් ඔය ඉෂුව එක මේ මොඩල් පේපර් එකේ තිබුණා මැඩම්
මේක නේද මේ ක්‍රෙඩිට් සේල්ස් එක නේද මම ඒකෙම question එක තමයි මම question දැන් combine කර ගත්තේ මේ මොඩල් පේපර් එක කරනකොට එතකොට මම මේකත් ගත්තේ ඒකෙන්ම තමයි ඒකයි
හරි මැඩම් හරි මට ඒක clear Hi, madam. Thank you so much.
හරි. Right. Any questions? සාමාන්‍යයෙන් වලට දැනගන්න තියෙනවා. All clear.
Thank you very much, madam. මේ session එක සුට්ටක් අපිට අර revise කරගන්න help වුණා.
මට තේරෙනවා ඔයාලා ඉතින් work කරන ළමයිනේ එතකොට ඉතින් මම කොයිතරම් අපහසුතාවකටපත් වෙනවද මම නම් කැම්පස් එන කාලේ මම සෙකන්ඩ් ඉයර් work කරේ නැහැනේ ඔයාලා එහෙම නැහැනේ ඒකයි මම arrange කරේ ඇත්තටම ඇත්තටම කවුරු හරි ළමෙක් ඉන්නවනම් පාඩම් කරගන්න බැරි වුණු මේ session එක revision එක කරගත්තත් එයාට 40 මාක් එකට යන්න පුළුවන්. ඒ නිසා අනිවාර්යෙන් ඔයාලා මේ paper එක attempt කරලා එන්න. Right. Any questions?
hello madam
Yes.
මැඩම් මම දැන් ජොයින් උනේ මම ඇත්තටම දැක්කේ නැහැ. මැඩම් මේකේ රෙකෝඩින් එක දාන්න පුළුවන් නේද?
මම නෙමෙයි රෙකෝඩ් කරන්නේ. මේ ඔයාලගේ යාළුවෙක් තමයි රෙකෝඩ් කරන්නේ. අපි යාටම කියමු ෂෙයා කරන්න කියලා.
හරි මැඩම් පොඩ්ඩක් ඒක මට පොඩ්ඩක් කියන්න
කවුරු
ඕනේ
හරි
ඒක.
ඉන්නවද මෙතන රෙකෝඩ් කරන කෙනා ඉන්නවද?
ඔව් මැඩම් ඉන්නවා ශාදින් ශරීෆ්.
මේ ශාදින් හරි මම කතා කරන්න මැඩම් ශාදින්ට.
හරි. ශාදින් හැමෝත් එක්කම ෂෙයා කරන්න.
Thank you so much madam. Thank you ශාදින්.
මේ සෙෂන් එක අනිවාර්යෙන් බලලා ගන්න. මේකේ තියෙන ගණන් ටික හොඳට හදලාගෙන එන්න.
Thank you very much,
Any
madam. Again.
questions? Okay, right. So then
Thank
hope you don't
Thank
have
you.
any
Madam, by the
questions.
way,
Thank you very much.
congratulations, madam. We have seen one post in LinkedIn that you have awarded for the best research or
Right,
something, no,
right.
madam?
Thank you. Yes.
Congratulations,
Recently, I
madam.
got
Congratulations.
my student got the best paper award for the Open University conference too, for the accounting
Okay.
and finance recently, last week. Right.
Okay, madam. This is awarded by Calani University, no, madam?
Yes, calendar year.
Okay. Congratulations, madam.
Thank you very much. Right. Okay, so if you have any question regarding the paper or anything to be asked, you can directly contact me. My number is in the LMS, right? So therefore, no issues. Anytime, even before the midnight, before the before the examination, you can contact me, ask any question if you have, right? So anyway, thank you very much. Have a good night. Thank you.
Thank you very much,
Madam,
madam.
we
Right,
have next
okay.
week.
much,
Thanks,
Okay.
madam.
you.
Thanks.
Thank you very much,
Okay.
madam.
Thank you, madam.
Okay.
Good.
Good night.
Thank you, madam.
Thank you, madam.
Okay.